$20,000 is vanishing from your dividend income over the next 10 years, and your current strategy won't stop it. Most dividend investors believe dividend income is a stable, inflation-proof wealth source. That belief is costing high-income households real money. According to BLS Consumer Price Index data, a 2% inflation rate reduces the purchasing power of a $100,000 annual dividend income stream by $2,000 in year one alone. Over 10 years, that compounds into a $20,000 to $40,000 reduction in what that income actually buys: groceries, healthcare, travel, everything. Your nominal dividend checks stay the same. Your lifestyle shrinks. The gap between what you think is happening and what's actually happening is the delta we need to close right now. By the end of this video, you'll understand the dividend yield curve strategy, a research-backed method to offset inflation erosion and maintain real income growth across multiple time horizons. Let's start with the math that most investors never run. A typical high-income household earning $100,000 annually in dividends from a mix of 3, 5% yield, VIM 2, 9% yield, and maybe some JEPI 10. 2% yield assumes that income is stable. It isn't. If inflation stays at 2%, the Federal Reserve's target, your $100,000 becomes $98,000 in real purchasing power next year. Year 2, $96,040. Year 3, $94,119. This isn't theoretical. This is BLS data applied to your portfolio. Where most investors go wrong is here. They buy dividend stocks or high-yield ETFs, collect the check, and assume the dividend itself will rise to match inflation. Sometimes it does. Often it doesn't, not fast enough, not consistently. A company that raised its dividend 3% last year might only raise it 1% this year. Meanwhile, inflation is running 2%. You're losing ground. This is why research shows that without a deliberate inflation-adjusted strategy, long-term dividend investors experience a 20% to 40% reduction in real purchasing power over 10 years compared to their initial income expectations. Here's where the dividend yield curve strategy changes the equation. The dividend yield curve is simple in concept. Different duration dividend assets yield different returns. Short-term dividend payers rate, some high-yield preferred stocks, ETF like JEPI, yield 8% to 12% but come with higher volatility and sector concentration. Intermediate dividend stocks like SCHD, which yields 3-5% with lower volatility, offer moderate yields with stability. Long-term dividend growth stocks compound slowly, but protect against inflation through capital appreciation plus reinvested dividends. The strategy is to ladder these across your portfolio based on your income timeline. If you need $40,000 annually from a $1 million portfolio, don't put it all in JEPI 10. 2% yield, high concentration risk in financials and energy. Instead, allocate $300,000 to SCHD 3. 5% yield, lower risk, broader diversification, $400,000 to VIM 2. 9% yield, growth-oriented dividend stocks, and only $300,000 to JEPI, high-yield, short-duration income. This diversification across yield curves does two things. First, it reduces concentration risk. JEPI holds 48% in financials and utilities. If those sectors underperform, your entire income strategy suffers. A laddered approach spreads that risk. Second, and more important, it creates a natural inflation hedge. As dividend growth stocks reinvest and compound, they gradually increase income in later years, offsetting the inflation erosion that happens early in retirement. Let's put numbers on this. Imagine you ladder $500 monthly reinvestment across a three-tier dividend yield curve. $200 into SCHD, $200 into VYM, $100 into JEPI. Over 30 years at blended 5% real yield, accounting for inflation, you're not just maintaining your $100,000 baseline income, you're building it. Research suggests this approach generates $180,000 to $220,000 in annual dividend income in year 30, in today's dollars, versus $100,000 in a static, non-laddered approach. The discipline is rebalancing based on inflation data from BLS reports, not just stock price movements. When inflation ticks above 5%, you shift 2% of your portfolio from long-duration assets into higher-yield, shorter-duration income. This is mechanical, not emotional, and it protects you while most investors are guessing. The stakes are clear. Ignore this and a $100,000 retirement income stream becomes functionally $60,000 to $80,000 in real purchasing power over 20 years. That's not a hypothetical loss. That's a lifestyle decision made for you by inflation. If you want the full numbers, the implementation spreadsheets, and the case files I couldn't fit here, the deep version is covered in the Compound Interest Bible, link in the description. The takeaway: dividend income is not automatically stable. A dividend yield curve strategy using SCHD, VIM, and selective JEPI allocation, layered with reinvestment discipline and inflation-responsive rebalancing, protects your purchasing power. Start now. The math compounds in your favor the earlier you begin. If this shifted how you think about dividend strategy, hit subscribe. Next video, the sector concentration trap hiding in your current dividend ETF, dropping tomorrow. Ring the bell so you don't miss it. What's your biggest takeaway? Comment below. Stay informed. See you in the next breakdown.